Good evening. Welcome to this live session. I am Vinod Nainani from Vallabh Investments. My father Ramesh Nainani started this firm in 1995. I have joined in since 2001. I am a financial advisor with Aditya Birla Capital since 2001 and also a certified financial goal planner. We help our clients achieve their goals through investing and protection schemes. Money is very important for everybody. Everybody makes investments. Some might make small, some might make big, but every investment is useful for each and every person because it is everyone's hard-earned money. We need to also understand that we need to manage that money well so that we can grow and we can be financially independent over a long period of time. So before we start this session, my topic for today is managing emotions and investments. And I would also request you to like the Facebook page of Aditya Birla Capital, where you can watch such more useful videos and live sessions. Also, professional advice helps you through market contingencies and ensure stable growth of your investments. Kindly click on the caption to call for a financial advisor who will help you achieve your needs and goals. During my session, please feel free to share questions, and at the end of the session, I will also answer all your questions. So let's start with my topic, managing emotions and investments. Before we get into managing emotions and investments, let us first understand the thing does not start with investments. It starts with a habit of savings. Everyone needs to save for the future. The future can be 1 month later or it could be 10 years later. But that savings, what we do for a 1 month later or a 10 year later, has to be linked to goals. So savings, investment, goals, all are interlinked with each other. So we need to plan what we need to save for when. Also, we need to understand that the pattern of savings in the year 2019 was different and 2020 is different. 2020, 95% of the people have been affected in some or the other way financially because of the pandemic. It has taken everyone by surprise, and there is no doubt about it. We need to learn a lot from this. So we need to plan our investments and for our future accordingly. What we people used to save for luxuries in 2019, now people are saving for their necessities. Priorities are changing. So we need to prioritize what is important for us. Yes, life will get back to normal. It might take some time. So, but let us plan through it. And this option of 2020, where there has been a problem for people in terms of loss of income, loss of jobs, or touch wood, there are people who are doing well in this point of time. Everybody has to plan for things. So let us take step by step into the financial journey. One more thing, in this pandemic, everyone has been low on emotion, and emotions play a very important role in your personal as well as investing life. So managing emotions and investments go hand in hand. We will first start with how important is investments and how important are goals when you start doing investments. So we need to first categorize ourselves between short-term goals and long-term goals. What are our short-term goals? Short-term goals can be our immediate requirements, contingency, medical requirements, and our EMIs if we are having any. Long-term goals could be planning for a vacation, planning for a car, planning for a retirement. Retirement is the most important long-term goal which people ignore that. You need to be independent financially when you retire. We are in a middle generation which is also called as a sandwich generation. We are taking care of our parents and we have to also look at our children. But we also need to ensure that our children might not look after us when we are getting old. So it is most important that retirement is given a top priority the moment you start earning. A small percentage when you start off it, and as you progress, you need to save for your retirement along with other goals. When you are doing investments and planning, you need to understand what is your risk appetite. Are you ready to see your investments go up and down? By that, I will give you a live example which happened in 2020. Somebody who invested in equity market in the month of February 2020, on 23rd March 2020, if he would have just looked at a simple picture, he had invested 100 rupees. That 100 rupees had become 60 rupees. Now, how would you react when your 100 rupees becomes 60 rupees? Will you withdraw that investments? Will you curse your advisor that he made you invest this? Or will you say this is an opportune time to add more? So you need to understand what investments you are doing, what is the risk appetite, and what will be the volatility linked to the investments. So investments have to be classified into conservative. What is a conservative investment? You would call a bank FD, your provident fund, a liquid fund in a mutual fund as a conservative investment. What would you call a moderate investment? A moderate investment could be a corporate fixed deposit, a debt mutual fund, or investment in commodities like gold. It could be a moderate risk. Something which could be an aggressive would be a equity risk. Are you ready to take a direct equity exposure? By my meaning by saying direct equity exposure is, for example, if you have invested in a particular security, during this correction which happened between February and March, there have stocks which have lost between 60 to 80% when the market has lost 40%. Are you ready to take that much exposure in your investments and that much volatility? Or you want to go via fund route and say, no, I'm happy with a 40% negative return, or I want a lower return which would be 20%, which that could happen through a mix of funds. So we need to build a basket of portfolio which will help you achieve your short-term and long-term goals. We need to also prioritize that what is our short-term goal. Before we do a prioritize of short-term goal, we need to make a contingency fund. What is a contingency fund? A pandemic came in. If somebody is into business, the money circulation stopped. How would he run his regular expenses when the circulation has stopped? So you need to keep a minimum of 6 months of expenses as a contingency fund in a bank FD or a liquid fund, which will help you navigate through these tough times. Also, if you are a businessman, you need to keep a contingency fund for your business. In this point of time, there have been people who have been running their business through the pandemic, but the cash flows have been an issue. So if you have created a sufficient reserves in your business, that would have helped you run your business in this tough times, even though your payments were not coming. Contingency fund is a short-term goal, but we need to also understand that we need to have protection for our both short-term and long-term goals. For short-term goals, the first thing important is health insurance. Health insurance will protect you and your family members in case of any hospitalization. And hospitalization bills runs into lakhs of rupees these days. So it is very important that you ensure that your health insurance is sufficient for yourself and your family. Also take into consideration that this health insurance should be sufficient for at least the next 10 years period, considering the inflation into part. After having health insurance, you also need to understand that your long-term goals should be set and planned along with your family, because you might have certain goals for your family might have certain goals. So we need to understand and we need to combine both the goals and make it realistic. You might have a particular goal that your son should go into a particular school. Your wife might have a separate idea. So it is very important to understand that both the goals are in line with each other, so that you can save for those goals accordingly. Also comes is protection. For your short-term and long-term goals, another important is term insurance. Term insurance will secure your family and your goals in case even if you are not there due to any unforeseen circumstances. People in India, especially businessmen, do not look to take term insurance because they feel it is an expense. It is not an expense, it is a saving to secure your family's future. I will give you a small example. Now, somebody who is buying a Skoda is ready to pay 50,000 rupees for the car insurance, but he is not ready to pay 50,000 on a term insurance. A car is something you are paying because it is mandatory. For term insurance, because it is not mandatory, you are not ready to pay. So according to me, term insurance should come first before your car insurance. First comes health insurance, then will come term insurance, and then you can protect the assets. If you are not there, how will your assets be protected? So you need to first protect your and your family's future. An important aspect in financial planning, whether it is short-term goals or long-term goals, is to disclose your financial health to your entire family. To the entire family, I mean your wife, your children, and your parents should be aware about your financial standing, whether you are able to satisfy their needs and requirements or not. There are many parents who do not like to tell their children about their financial health, and the children are expecting that as their friends are going abroad for higher studies, they might also end up going, and then the parents are in stress to send them abroad. But once they are aware, children are also matured enough to understand, okay, my parents cannot afford this, so I need to be reasonable and maybe do something better here rather than spending so much for my father's money and going abroad. So once this financial health is known by everyone in the family, the expectations are met. So we'll move to today's topic, which is managing emotions and investments. Emotions and investments go hand in hand. It is like greed and fear. Now, there is one part which is known as greed. Why the greed? You have seen your neighbor who's there, he's bought a vacation home in Lonavala. So you also want to buy a vacation home because it is a good vacation home. Plus, he's also seen the price appreciate to double in the last 1 year. Why are you going to buy the house? Is not because your neighbor has it, but because he's doubled his money on a vacation home in the last 1 year. So this is the greed. You also want to change those returns. This is what is greed. This greed could also happen in stocks or in equity. Now there are a lot of investors, when markets are down, they would say we do not want to invest in equity because markets could go further down. And when the markets are going up, you have seen your colleagues making money and they have already made money. After that, you jump into the boat saying that I also want to make money. So you need to understand whether you are doing the right action at the right time and does it suit your needs and requirements. So let's take a live example of 2020. Pandemic has affected the financial markets in a very big way. Let it be your interest rates to stock market to bond markets. It has affected each and everyone in some way or the other. There were a lot of people who were doing fixed deposits for 1 year saying that the rates are very high and I will keep my money liquid. But suddenly in this last 6 months, the interest rates have come down by 2 to 3%. So a lot of people who are retired, they have to settle for a lower rate of interest. How practical is that? They are going to have a tough time. So you need to keep your deposits for long term and short term also. There are some people who will say I do long term deposits because interest rates are high. So when interest rates are high, it is better you do deposits for long term. When interest rates are low, you do deposits for short term. So that you have to see the probability when the rates are going to go up or down. Another example which I will give you is in the month of March, due to pandemic, liquid funds gave negative returns for almost 3 weeks, which nobody in the financial system would have envisaged that this could have happened. And the things got normalized in 2 days after RBI reduced the interest rates and intervened with their measures like LTRO and TLTRO. So you need to understand that you have invested in a liquid fund. Yes, everything today is mark to market, so that nobody who is entering at a given date takes undue advantage. So it's a fair price valuation matrix which goes on. So you need to also look into picture that when markets have corrected from 42,000 to 26,000, it is a 40 to 45% correction which has happened in the market. At that point of time, you hear news from people that markets may go to 20,000, markets may go to 15,000. That is where is the fear and the panic. And sometimes in that fear, you don't realize that what mistakes you are committing. You are booking a notional loss into an actual loss. The loss is a paper loss. It wouldn't be an actual loss unless you book it. So let's say scenario A where Mr. Ram is there and scenario B where Mr. Vijay is there. Both have invested in the same kind of a portfolio and two different people altogether. In the month of March, Mr. Ram could not bear the negativity in the market and he sold off at a 40% loss and invested that money in a fixed deposit at 6%. Mr. Vijay, who held on with his investments because he knew that these investments I am going to need after 5 years. Situations will come back to normal. It is not the end of the world. At this point of time, he has seen his values recovering to almost 95% of what it was in January. So this is what temperament and emotions are there. You do not have to be carried away by the news and rumors. You need to sit with your advisor and understand what is happening. Take assess of your situation. Yes, at this point of time, if somebody has high interest loans going on, you need to see whether your investments are earning lower than that or not. Are you able to service your debt? So emotions are very important. I will give you another example. Whenever there is crisis in the financial markets, you also see tight liquidity, which happened in the year 2008. In the year 2008, people were considering that during the Lehman Brothers crisis, that HDFC as an institution will also go bankrupt. That's why the bonds of HDFC were not getting traded. But that was the time somebody could be smart and take selective exposures to there, and you know the top institutions which are there in the country will not fail, nor the government will let them fail so easily. Let's say scenario A, Mr. Ram, and scenario B, Mr. Vijay. Both have identical portfolios but are two different individuals. Now when this market correction happened, Mr. Ram could not bear the loss which he was seeing on paper, and he was too fearful that the markets might go down, and he booked his notional loss into an actual loss and invested that money at 6% in a fixed deposit. Now to recover that 40% loss, it will take him almost 7 years to recover that loss. One action of Mr. Ram has costed him so much. Now Mr. Vijay on the other hand held on to his investments because he knew that he doesn't need this money for the next 3 to 5 years, and he knew that things would come back to normal or sanity in due course of time. Now as we sit 6 months later, within 6 months later, Mr. Vijay has seen his valuations coming to 95% of what they were during the pre-COVID levels. So patience what was there, and his temperament. He stood by his emotions and said, no, I don't have to get carried away by what people are saying. He sat down with his advisor, did a thorough assessment of what he was holding. There was no overexposure what he had done. On the contrary, his advisor also advised him that if he has some additional surplus which he doesn't need for the next 3 to 5 years, he could look at taking an opportunity in this market by investing that and making some additional returns on it. So it is also important to see that in this point of time you have to assess if you have any loans going on, whether you are able to service those loans or not. Otherwise, and your investments, if they are earning you lower than your loans, then it is better that you close your investments and pay off your loan. So greed and fear. I'll give you another option. Example here. Let's say gold. Gold in the last 6 months has gone up almost 30%. And now people have started realizing now, oh, we have missed the rally, and there are media reports stating that gold might go to $4,000 an ounce. Currently the price is around 1950, 1975. So people are anticipating that gold will go up. So everybody is now lining up to put all the money into gold. So you cannot put all the money, you cannot have any disproportionate allocation because a particular asset is giving you high returns or low returns. You have to give allocation as per the merit of the asset, the volatility what you can bear, and also your goals. So it is also have to look at the temperament. Now a person like Mr. Ram who does not have a temperament should not invest in equity because he cannot see that volatility. There are many people who say that no, when markets will go down, we will stay put, we will not withdraw the money. But when the actual scenario happens, they behave in a totally different manner. So it is important to do a risk assessment or a client profiling, that what kind of product suits an investor, so that when there are tough times, your advisor can come and tell you, sir, this is what you had, your risk profile is. This is what you said you will do when markets will go down or markets will go up. So you need to also do rebalancing. Rebalancing of portfolios is very important. What is rebalancing? Mr. Ram was investing 70% in equity, 30% in bonds. So ideally, he is a 70% equity investor, 30% bond investor. So if his equity portfolio is going down by 20%, that means his 70 rupees in equity has become 56 rupees. So he has to transfer money from bonds to equity to ensure that the ratio is 70-30. And that is how you can maintain a proper asset allocation. And similar way, you have to also do it when the markets are going up. If markets have gone up and your 70% equity has become 85% because of the rise in valuations of equity, you do not have to be greedy and say, I want to make more money. The best way is you have to reduce that 15% additional money into equity by booking your profits and putting the money into bonds. This is how you can achieve your financial independence and move a step further towards your goals. Sometimes people feel I will retire at the age of 50, but some people who are very disciplined and who follow a systematic approach to their investments and goals and financial planning, they might be able to achieve their goals much beforehand. Or maybe at that point of time they have, oh, I can maybe improve my lifestyle, I can give better quality of life to my children. One thing I would also like to add is, never get emotionally attached to your investments. What do I mean by getting emotionally attached to an investment? Let's say, for example, a particular mutual fund has given you spectacular returns for the last 10 years. Now, it is not necessary that it will continue giving you spectacular returns in the years to come also. So you need to evaluate it on a regular basis and not get emotionally attached to it. Because getting emotionally attached could also hamper your returns in the future. I will not name the fund, but there is a particular fund which did phenomenally well from 2004 to 2015. Now when I look from 2015 to 2020, it is in the bottom quartile for the last 5 years. If somebody was very emotional to the fund, saying that this fund has made money for me and it will make money in future for me, yes, it would have made money for you in the last 5 years, but it has made money for you lower than a fixed deposit. So don't get emotionally attached to your any investment, whether it be a mutual fund or a stock, because you have to evaluate the investments as per their risk appetite, the fund manager who's there, what the portfolio is there. The same could happen to stocks. There are certain stocks which have not given returns for 10 years at a stretch, and those are large cap stocks. So you have to take a holistic view of what the company is, how the performance is. If something is not doing well for 1.5 years, be it a fund or a stock, You need to decide and reduce the exposure or exit the exposure. But do not do that to the asset class, because the asset class as a whole, if it's not doing well, it will bounce back in future. So if somebody will look at equity returns for the last 2 years, people will say, why am I investing in equity? I should have invested this money in a fixed deposit. But when you invested in equity 2 years ago, you said that your horizon is for 5 to 10 years. Then why are we looking at the returns after 2 years and saying this has not beaten fixed deposit? You cannot compare a fixed deposit to an equity. You cannot compare gold with a real estate. All asset classes are independent of each other and all will give you different returns over different point of times. It is not necessary it will always give you positive returns. I will give you another example. Real estate for the last 8 to 9 years has been flat to negative. Has anybody gone and said, okay, my real estate is giving me negative returns, I should go and sell it? Or if we look at gold in 2017, from 2012 to 2017, gold had not given any return in dollar terms. On the contrary, it was negative. Did people start selling the gold what they have in their house? No. So you need to be practical what you are doing and not get emotional. Don't attach emotions to your investments. Emotions are there to be there with family members and not with your investments. You have to be practical and take decisions, informed decisions, not decision but informed decisions, calculative decisions. Do not take any decision in a hurry or in saying that, oh, market temperament is this particular is this. Do a thorough analysis and then take a call whether that this decision is right or not. Once you have done that, that means you have let your emotions be aside and taken decisions for your investments on basis of the merit what they deserve. Once you start doing that and evaluate your investments as per the right way, then you will definitely see success. Then even the fall in the market in 2020 nor in 2008 will affect your investment decisions. On the contrary, it might make you wise enough and say, oh, these are good times to invest, turbulent times, I have the patience, I have the liquidity, I have the time in hand, so I can take calls. Or you might also say, okay, real estate market has not done well for the last 8 years. If you look in terms, I have invested this money in a fixed deposit which has grown. Maybe it is the time to buy the property. Maybe you could buy, if you are planning to buy a 1,000 square feet house with that particular money, today maybe you can buy 1,500 square feet with that money. Or you can say, okay, I bought 1,000 square feet flat at 70 rupees of my budget, then the 100 rupees. So it is the way you think and the way you look at things. So once you have a clear view of what you want to do and how you want to do, it will make your life simpler and it will also help you achieve your goals. To sum up, I will take of what all things I have discussed. Savings, habit of savings is the first thing which everyone has to inculcate. The habit of saving will transform it into investments. When we begin the investment journey, how important is contingency fund? What are our short-term goals? What are our long-term goals? How important is protection, health and life in these short-term and long-term goals? The other thing which we have also discussed is we need to discuss the financial health with the entire family. That will make your life much easier. Then I came up to the topic of today is managing emotions and investments. Emotions, keep the emotions away when you are doing your investments. Have a holistic approach, do right evaluation with your advisor, stick to your goals and the plans. You need to tweak plans because plans need to be tweaked because 2019 has been a different year than 2020. If your plans are correct, then tweaking will be to the tune of 10 to 20%. You don't need to tweak 100%. 100% tweak is required when there is a sudden change in your needs and requirements. Let's say suddenly you decide and say, okay, no, I need to buy a house now, then that would require a change of plan. So emotions, if they are kept away from investments, or I would say if emotions are managed in the right way, the investments can be a success. This concludes my session. Thank you for your time and attention. Now I will start taking all the questions one by one. The first question is from Seema Bansal. Her question is, I am very attached to my parents. I have just started working, but I want to ensure that I give my parents a good life and a comfortable retirement. How should I plan money for this? So Seema, my answer to this is, first you need to see what is the age of your parents and after how many years you want them to have a comfortable retirement. So depending on that, you need to start saving in an SIP. It could be in a debt fund, equity or hybrid, depending on how much time you have in hand. And as they near their retirement, you'll have to convert that more into a fixed income instrument. And post retirement, maybe you can have them invest in a senior citizen savings scheme where they could get regular returns, which would help them steady income during retirement. The next question is from Anandita. I have an old health insurance policy of 2 lakh cover, which I have been renewing for the past 5 years. But now in my current company, I have a health cover of 7 lakh. Should I still continue renewing my old policy? Anandita, yes, you should continue renewing your old policy because tomorrow you never know, you are switching jobs or you are leaving jobs, you are starting something on your own. So during that interim period, if something happens to you, some life or some health cover of your own is important, which will help you secure your finances in case if there is any medical emergency during that period. The next question is from Ketki. I am planning on quitting my job and starting something small on my own. If my business fails, how do I ensure I am financially sustained? Ketki, this is a very good question. First thing is, once you are starting your business, that means there will be no guarantee of how much you will be making in the initial couple of years. How will you manage your cash flows? So it is very important that you keep a minimum of 1 year of a contingency fund and reduce your equity exposure in your investment portfolio to the minimum, because you are taking risk by getting into a business. So there is no guarantee of income and you don't know how far it will sustain and when will you start achieving a positive cash flow. So it is very important you keep your investments at low risk, and the moment you see your business is doing well, you can start getting back to your original plan. Question from Bindya. I have just started working and want to plan and manage my money in the best possible manner. How can I create an ideal financial plan? Bindya, this is a very good question. It is very thoughtful of you to start planning at such an early age. So I would suggest that you have to make 2 goals, short term and long term. Short term will be in the next 1 to 5 years, long term will be 10 years and above. So you need to decide that how much money you will need in the next couple of years for your small vacations, if you have to buy some car for your own or something, and maybe if you want to save up for your marriage and all those things. So you need to dedicate and plan for that. So whatever are your short-term goals should be in low-risk instruments so that there is less volatility, and when you need it, you get the amount at the right time. For your long-term investments, definitely you should look at equity as an investment, because equity will help you beat inflation and help you grow your wealth too. Question from Parikshit. I recently withdrew my PF money and have some extra money on hand. With that money, do I pay off my loan to save my interest or invest that money? Parikshit, definitely you should pay off your loan, because loan will have a higher rate of interest, and the earnings what you will get on your investments might be at a lower rate. What you can alternatively do is, when you close off your loan, the EMI which you pay for your loan, you should start saving up that, which will be useful to build up your investment portfolio. Question from Karna. Last month I lost a huge sum of money and I'm quite stirred up emotionally. How do I recover the losses by investing the little money I have left on me? Karna, you have lost money and you are already disturbed emotionally. You have only little money left. So kindly do not speculate with that money. Be wise, take help of a financial advisor and plan your investment so that whatever little money is there, you can grow it in a gradual manner, in a logical way rather than speculating or saying that I want to make quick money. Question from Sneha Batreja. I have been thinking about starting an SIP, but I am scared that this may not be the right time to invest in mutual funds. Please advise. Sneha, it is always a good time to start an SIP because SIP first of all is building a habit. And in an SIP, you are doing an SIP for a long term. And over a long term period, the SIP helps you do a rupee cost averaging. Rupee cost averaging will reduce your average cost and gradually help you build up your investments. Let's say, for example, you want to start an SIP of 20,000 a month. Over 1 year, you would invest 2,40,000. Over a 5-year period, you have invested 12 lakhs. Now, this 12 lakhs would have been built up in over an equity fund portfolio. Whereas in these times, if I would have asked you to invest 12 lakhs lump sum, it would be difficult. So SIPs are good. Diversify your SIP into 3 to 4 funds across different categories, or maybe 2 from each category, and start your SIP immediately. Question from Sanjana. How do I create a financial plan to manage both health protection and wealth creation? Sanjana, for you, for health protection, you have to take a medical insurance or a health insurance. In a medical and health insurance, take a basic policy of 5 lakhs or at the most 10 lakhs, and for a balance amount, you can take a top-up cover which will help you reduce your cost. By this, what will happen is you have covered yourself you have protected your health. Now coming to wealth creation, take a different basket of assets. Let's say you can take some amount in a bank fixed deposit, some amount in a debt fund, some amount in an equity fund, and if you have knowledge about stocks, or consult an advisor and build up a proper wealth creation plan which would help you reach your different milestones in life which you have in mind. Question from Ashmak. Should I sell off my ancestral house to pay off my current home loan to save on the home loan interest? Ashmak, this is a good question. Now, some people might be emotionally attached to their ancestral home. But when you are doing your finances, you have to keep emotions on side. Now, you have to see whether is somebody using that ancestral house or not. If it is on rent or not, and is the property appreciating or not, or will in future you will be using that property or not. So if the answer is no, or if your property is on a rent and that rental yield is 2 or 3% and your housing loan would be 8%, so it is better that you sell off your ancestral property and pay off your loan, and whatever EMIs you are paying towards your loan, start saving that wisely, because that will help you build up a big corpus for your retirement, for your children, or any future needs, or maybe tomorrow if you want to buy a bigger house, that corpus will help you achieve goals which you have for the future. Question from Ritika. I have no dependents. If I have good enough contingency fund, do I need health insurance? Ritika, your point is correct that you have enough contingency fund. But today, due the way the medical costs are going up, you never know what will be the medical cost which will come up if you come up with any disease. Now there is also one more thing, that you might end up living too long. So when you are living too long, you need contingency fund, and health insurance will help you save that contingency fund, because when you live long, your money will start depleting because of inflation, because you won't be taking risk with your investments. So I would still advise, have some decent amount of health insurance even if you have no dependents. Question from Seema Paul. Given the current situation, is it a good idea to buy a car that costs 15 to 20 lakhs on a loan? Seema, you have an aspiration to buy a car of 15 to 20 lakhs, you can definitely buy, provided during this current situation your income has not down, you are saving as much as you are, and it will not affect any other financial or physical assets that you own. So you need to ensure that you will be able to service the car loan properly and you are going to use the car and you will enjoy having the car with you. So there is no harm in buying the car, but just ensure that you have a financial check across all the four corners and then go ahead with it. Question from Vikram. I think there is a great opportunity to get high returns in these current markets, but I am not sure what percentage of my money I should put in the markets without getting impacted if the markets go down. What should I do? Vikram, the opportunity is there. Now, opportunity for high returns in short time is a question mark. So I would not tell you to invest with an anticipation of high returns to start off with. Plus, your other part of the question is what percentage of your money you should invest so that you are not impacted when the market goes down. So you have to ask your question to yourself, if you have 50 lakhs in hand, how much of that you wouldn't mind seeing it going down by 50% if tomorrow the market falls. So if you have 50 lakhs, are you ready to see that 50 lakhs becoming 25 lakhs? Or you're okay with seeing 20 lakhs becoming 12 lakhs? So you have to ask that question to yourself, how much amount you can withstand for that volatility, or you are ready to see the negative side of your money. That will give you the answer that how much percentage you should invest. And what is the time horizon of this amount? If your time horizon is 5 years and above, 5 years, 7 years, 10 years, the longer the period, the higher the percentage you could invest in the risky assets, but take a calculated risk. Don't close your eyes and just take up any risky asset. Question from Bikaram. My family of 4 has been wanting to take an international vacation for a very long time, but this will require me to withdraw my mutual fund investments or take a personal loan. Which is a better option and why? It is very important for family to take an international vacation, so kindly go ahead with it. Now, depending on which mutual fund you have, if your mutual funds are giving a reasonable return, definitely withdraw the mutual fund and go on an international holiday. And what amount you would have paid for a personal loan, start saving that as an SIP in a mutual fund. Now, why I am telling you is because when you take a personal loan, the interest rate will vary from 12% to 18%. Now, in current scenario, it is very difficult to anticipate that you will make 12 to 18% return over the next 1 year, 2 years or 3 years. So it will be prudent enough that you withdraw your mutual funds and you can go for a holiday. But on the sidelines, whatever amount you would have paid towards your personal loan repayment, that much amount should be invested in an SIP immediately before you start your holiday. Question from Loveleen. Over the past couple of years, I have invested a good amount of money in the stock markets, but the current market volatility is worrying me. Should I look at reallocating my funds? How should I go about it? Loveleen, this is a very good question. This is a concern of many of the investors after seeing the current fall in the markets. So one thing is there, when will you need this money? If you think you will need the money over the next year or two, then definitely you should start looking at reallocating the money because markets are revisiting towards the previous highs. If you know you can withstand the volatility, or you have to hedge your investments by adding some gold to your portfolio, adding some bonds or debt funds to your portfolio so that you can reduce the volatility. So one thing is, if you need the money over the next 1 or 2 years, then definitely you should start unwinding because you don't know where the markets will be a year or 2 years later. But do not withdraw everything at one point of time. You can opt for a systematic withdrawal plan so that you can gradually take the positions of the market rather than taking out at a one particular date. Question from Arjun. I have equity shares worth 20 lakhs. I am confused whether I should sell them to pay off a loan I took up for my startup or continue paying my EMI till the end of the term. What would you advise? Arjun, if you have equity shares which are good blue chip companies and they are giving you a reasonable double-digit return on your portfolio year on year, then I would suggest that you hold on to your equity shares and continue paying the EMI which you have taken for your startup. That will also help you know how much money is your startup making and are you able to service your EMIs? Are you cash positive with your startup or not? So look at the shares. If they are giving you a good double-digit return, they are blue chip stocks, and you know you have made money on them. So might as well better hold on to those shares. So I think these are all the questions we have for now. Thank you everyone for tuning in to this live session and making it a success. I hope you have enjoyed it as much as I am. But don't forget to like the Facebook page of Aditya Birla Capital to get notified of such useful videos and live sessions. Click the caption above or below to request an appointment from a financial advisor who will help you create your finances, grow your wealth, and also advise you on protection schemes. Thank you very much. All the best.